if we're talking about the Fed pausing on interest rate hikes here, guess what that means? There's financial stability problems, and that is not going to be solved by the Fed in one meeting. We're not just going to have a resolution next week. There's going to be a longer, more protracted fallout. So even if the Fed pauses next week, that's not necessarily great for stocks because that is an admission of something else going on. Now let's take a look at the Wi-Fi Interactive. We have all the major indices in the red. Small caps, which were leading the way up yesterday, down by 2.5%. All the majors down more than 1%. And I want to get to the inside of the market here. Here's a look at the sector action. Everything in the red. To the upside, utilities, staples are the least bad. Those are defensive sectors. Energy, I mentioned towards the open or towards the beginning of the hour that crude oil had fallen below $70 a barrel for the first time in months. That is being reflected there. Financials, those are down 3%, not particularly a head scratcher there. Materials also down more than 2.5%. Let me take a look at our leaders. We had a lot of green on the screen yesterday, and now we're seeing value stocks. Those are up 1%. LQD, that is a corporate bond ETF for safe corporate bonds, that's up. And then meme stocks, maybe a head scratcher there. But to the downside, KRE, the regional banks, down another 5%. BETS, that is a gambling ETF, solar. Anyway, you get the picture. Very much a risk on yesterday, risk off market today. And let me just take a look at volatility, see what the VIX is doing. It had punched up above 30 a couple days ago. And we can see it's at about 27 right now. And let me just check the B of A Move Index once more and show everybody what's happening here. We had a huge jump up, and I couldn't even see it on the earlier chart that I was posting. I think it was at 169. There we go. Highest level that we have seen since the global financial crisis. So just goes to show you when we have this incredible volatility in the bond market and it leaks over into everything else, then kind of risk off here.
Yeah, most definitely.